Hello, and welcome to Money Mystery No More. You may be a history buff or an economics whiz, but are you familiar with both events as they relate to the various market crashes? Let's talk about what happens with a market crash and the economics impact because you may find it quite fascinating. Plus, you'll really benefit and get the most out of this video when you take heed to the lessons learned after listening for the common calamities. Pay attention and take notes because there is some fascinating history and nuggets on how you can benefit by keeping it simple. It's awesome, and remember, hit that subscribe button to keep getting the latest and greatest information. Okay, let's remove the mystery. Oddly, you won't find an actual definition for market crash or stock market crash in the dictionary. Not in Merriam-Webster, Dictionary.com, or the Oxford English Dictionary. Interestingly enough, each has been around for many years and a couple for over a century. A couple even lived through several stock market crashes. These historical devastating events rock financial markets, industries, and millions of citizens around the world. Instead of the dictionary, a simple Google search on market crash and stock market crash will yield lots of content, articles, and many different iterations on the subject. You'll see the economic impact is almost always long-lasting, felt in all walks of life, and they always make the news in history books. Condensing it down for you, notice key words and phrases typically used to describe a stock market crash involve a sudden, rapid, dramatic, steep drop or decline. That is then paired with something about the value of stocks, stock prices, or the prices of individual stocks. Then it's usually followed by something involving the amount, such as 10% loss very quickly, or leads to a market-wide decline, or even a drop of 20% or more. Pieced together, a stock market crash is known as an unexpected, abrupt, and sudden drop in the prices of stocks and stock value. A market crash is perceived as bad. If there was a 20% drop or more from a recent high, some call that a crash, but others say it's only a 10% drop that is considered a crash, while some just say that a 10% drop is a correction. Regardless of crash or correction, it's commonly accepted that a market crash is spontaneous, surprising, and occurs with no warning, so they are shocking in nature. Because they can happen instantly or seemingly so, they tend to cause panic and terrible anxiety for some people, which often leads to a negative impact on society as a whole and causes economic hardships and downturn. A market crash seems to happen when there's turmoil in the economy or in the political arena. All you have to do is think back and remember the times when the economy doesn't feel good. There is an unspoken weight of bad, slow, or depressed market conditions due to high cost, high inflation, high employment, and so forth. There is general fear of a recession. Throw in the ongoing negative news cycle, reminding you every minute as well. Sound familiar? Sure it does. You can easily visualize and feel some of these factors because they are real. They are commonly involved each time there has been a market crash. Regardless of the cause though, things happen. There's a rapid, widespread, and steep decline in prices due to high volatility. Trading volume leans hard on the sell side with low demand to buy. Some companies go out of business or lose so much money they go bankrupt. There are individuals and investors that lose a massive amount of money. Liquidations occur due to panic selling and/or mass sell-offs. Unemployment spikes due to mass layoffs and economic uncertainty. Government intervention, or at least calls for it, to implement more rules and regulations to prevent such devastation going forward. And let's not forget about all the finger pointing. It's endless. That's a heaping mound of negativity pointing out that a market crash and the economic impact are brutal. History is a great learning opportunity though, and the United States has plenty of proof and stories to reminisce over. Let's review the Big Five, my unofficial name for now. In roughly a 100-year span from 1929 to 2024, there are definitely 5 well-known market crashes to spotlight. There will surely be more, but hopefully not within the century we're analyzing. The Big Five are the 1929 stock market crash, the Great Depression, then the 1987 Black Monday crash, followed by the 1999-2000 dot-com bubble, and the 2008 financial crisis, and finally, most recently, the 2020 coronavirus crash. Considered the worst market crash in history, most agree it was also a trigger of the Great Depression. From 1921 to 1929, the Dow Jones Industrial Average rose 218 points from a mere 63 up to 381. While exciting times of a prosperous market boom and huge economic expansion, the 1929 crash brought a swift end to the Roaring Twenties. It began on September 3, 1929, followed by a 2-day infamous crescendo on October 28 and 29. Black Monday resulted in the Dow dropping 13% immediately, followed by Black Tuesday, shrinking another 12%. That's 25% lost in 2 days. Then the next 3 years saw the Dow collapse to 41 points, which was a devastating 89% loss from the heyday prior. Sadly, it took another 2 decades for the Dow to recoup the value lost. Many years and market crashes have passed since then, and a lot has been learned. Mainly that the 1929 crash was caused by too much debt, excessive leverage of investments, which was intertwined with too little skin in the game. People were only paying 10% of a stock's value, buying on margin. Stock prices were inflated. Then heaped onto the mess was heavy buying of consumer goods on credit. People were in debt, really overextended. That debt bubble couldn't handle the pressure, resulting in what is known as the worst market crash ever, and the economic impact was felt around the world when that debt bubble burst. If there was any positive news from this period, it was the concept of the FDIC and the SEC being introduced. The Federal Deposit Insurance Corporation insures bank deposits and is supposed to reduce bank failures. The Security and Exchange Commission is supposed to provide market stability and protections based on rules and requirements which give investors more transparency. Fast forward another couple decades and again, another Monday, October 19, 1987. The Dow sank 22%, which is the largest drop in stock market history for a single-day event, and it just got worse from there. Fortunately, this market crash and economic impact were far less devastating. Its recovery started a month later, and all losses were recouped by September 1989, within just 2 years. This market crash was caused by different forces. It might seem odd, but computer programming caused lots of sell orders to flood the market. Investors in turn freaked out and started to panic sell. Sure, there was economic and political churnings, but it was really the programming issue that led to this Black Monday crash. Because of this, the SEC mandated a solution still used today, requiring exchanges to add circuit breakers which basically stop trading. The idea, depending on the size of the drop, pauses trading activity to allow people some breathing room to figure things out and avoid further panic selling for the next several hours or even a day. The third event. Then along came the dot-com bubble. Internet-based stocks were the rage and doing well. So well, in fact, the tech-heavy NASDAQ from 1995 to 2001 had an epic 4,000-point climb to its magnificent peak on March 10, 2001. Sitting at an all-time high of 5,048.62 points, what followed was truly jaw-dropping. Imagine, only an approximate year and a half later, on October 4, 2002, the NASDAQ shed 3,908 points, an astounding 76% of its prior value. Once again, it was inflated stock prices. Investors speculated that tech stocks would be super profitable, even when there was no sign of revenue. Prices climbed. It seemed too good to be true. It was. When the Federal Reserve Board began tightening monetary policy to prevent inflation, the dot-com frenzy closed shop. NASDAQ took a significant hit with this loss, taking nearly 15 years to recover. History repeats itself, but eBay and Amazon survived the $5 trillion wipeout. Funny side note, you could have bought Amazon during this low period for $11. Nearly 80 years after the Great Depression of 1929 came the Great Recession, which lasted from October 2007 until March 2009, the fourth event. While the duration seems low at just 17 months, it took another 4 years to recoup the loss. A nose-diving Dow dumped 54% of its value from a peak of 14,164 points. Most people in that era recall the failure of the infamous financial institution Bear Stearns. Their situation illustrated foolish investments once again, but this time in the real estate industry, specifically mortgages. The Federal National Mortgage Association, FNMA or Fannie Mae, lowered credit standards and allowed high-risk borrowers a pathway to financing a home. Their mortgage terms were high interest rates and variable payment schedules, as subject to their subprime poor credit. Yes, for real. Can't make this stuff up. Obviously, this led to a tidal wave of problems fueled by tons of homes being mortgaged by people that couldn't handle them. Plus, it led to home necessities also being purchased, often resulting in even more debt to those same high-risk borrowers. Making a bad situation worse, investors started packaging the bad mortgages as investments. When defaults began to occur on millions of mortgages, those institutions began hemorrhaging money and couldn't meet their own debt load. It all imploded magnificently with a terrible recession. The market crash and the economic impact is obvious here, but it does offer a reminder why strong credit is important as are financial controls with responsible lending practices. Another government intervention, bailouts, more laws, and more bureaucracy were implemented with hopes of preventing a repeat situation like the subprime mortgage debacle. The fifth big one. Then the US got a little 10-year break until the COVID-19 epidemic struck. The Dow tanked 4 times in under a month, with single trading day hits of 11%, then 12%, then 9%, and again a 12% hit. All that from February 24 through March 16, resulting in the coronavirus crash of 2020. The recoup of loss was swift though. Just a couple of months later, the Dow was back to its previous numbers. Massive government intervention may have helped with the unprecedented $3.7 trillion money injection to the money markets and to citizens in the form of stimulus payments. However, the job market suffered severely with skyrocketing unemployment hitting nearly 15% at one point in April of 2020. Hopefully the Big Five clearly demonstrates the power of a market crash and the economic impact wrought on so many businesses and people. While not a pretty situation, history does provide insight of the repeat offenses along with opportunities for prevention. It seems a market crash trigger may lie with debt, especially margin debt and a debt-fueled economic boom, or with long-term speculation of certain industries or companies, or perhaps in a long bull market run of certain stocks or indexes climbing too high for no apparent solid reason, other than, perhaps, sheer speculation and amped up dialogue. Whatever the reason, when the crash begins, the average reaction is panic. That leads to an accelerated sell-off, causing prices to quickly drop more. It's a vicious little cycle with the pain taking many forms down a path to recovery that can take months, years, or decades after a trail of loss and devastation to business, consumers, society, and citizens. What is also known though, and proven repeatedly, is that emotions tend to take over logic and calm. Remembering a few things may help keep this and your finances in check during such situations. Diversifying into many types of investments helps spread the risk around versus a heavy concentration of just one company or industry. Also, keeping a fair cash reserve will help in tough times. And perhaps most importantly, if you are involved with investing, you must think long-term, period. Long-term is the name of the game because time has always weighed in for the win, for gains over the long haul. In the end, market crashes are like little dips, bumps, and detours along the journey. And fortunately, U.S. history has shown that the market will recover. Another real consideration is to be a person that does not panic. People that don't panic sell might just be savvy and buck the status quo by purchasing more during the dip. Again, historically, those folks won big with great returns financially. So being realistic, it's a lot easier to expect and accept those little dips, bumps, and detours while keeping your eye on the destination, the end game, by keeping it simple. Remember, hit that subscribe button and turn on notifications so you can keep getting the latest and greatest information from Money Mystery No More. I'll see you in the next video.